What do you look for in a passive real estate investment to maximize your ROI? Look, guys, we all want our money to work for us. We want it to double and we want to sleep well at night. But what are the things that we need to look for in the investment to make that happen? By the end of this video, you are going to know. If you stick around to the end, I'm going to show you a secret way that a lot of syndicators really stick it to their investors and pull the rug out from under them. And I want to make sure you avoid that. All right. So the number one first thing that you need to look for is maximum tax incentives. So most people that are passively investing in real estate are doing it with their W-2 income. Now, if you're investing through your 401k, you can skip to the next part of the video. But if you're investing with cash, you want to make sure that you have maximum tax incentives. So you want to ask the syndicator, what amount are we expecting to be able to get back on our taxes this year? Right now, we are seeing between 40 and 60% of the cash that you invest available in a tax incentive this year. This is through accelerated depreciation and through what is called a cost segregation study. Now, if your syndicator says we haven't done the cost segregation study yet, that's normal. Most people don't do it till after the close, but you can get a preliminary one done. This will cost them maybe $1,000, but it lets you know as an investor what you're going to get back. Right now, our current deal, we are doing 55% is what we're expecting. So if you invest $100,000, you can usually, what we're planning for is a 55% back in your taxes this year. If you guys don't know the story of Home Invest, Nate last year, his tax liability was 250 plus. He owed over $250,000. One deal not only wiped out his entire tax liability, but it also took care of all the investors as well. We got over $980,000 back on one single property. It was a great find, and not only did it provide cash flow, but it gave everybody invested a huge tax benefit. All right, so that's number one. You want to make sure to know what your tax incentive is. Number two, this is how you don't get burned. If you guys saw in Texas, a lot of people with apartments saw all of their cash flow evaporate, and a lot of people actually saw capital calls, and there were even a few bankruptcies caused by this. And it was because the state was running a deficit and they needed more tax revenue. So what did they do? They went to property taxes, and property taxes went up by 3x. In some places, it went up as much as 5x to cover that. So what do you want to look for to avoid this? Everybody thought Texas was a great state to invest in. You want to look for, is the state running a surplus or a deficit budget? Right now, we are in Kentucky for about a year and a half. One of the reasons we've been going so hard in Kentucky is because they have a surplus budget as a state. They're not going to be raising property taxes anytime soon. Now, nobody has a crystal ball. You don't know all that stuff, but this is one of the biggest indicators that we've seen. The other thing, kind of a footnote to this, is you want to make sure it's a landlord-friendly state. I would not want to be investing in California right now. Why? If they have to evict somebody, you can actually have to end up paying that person $50,000 to $70,000. It is very hard to make money in real estate if you're having to pay your tenants when they leave. So you want to look for landlord-friendly states. That's number two. The third thing, this is a really, really hot one. You want to make sure that you are investing with an experienced syndicator. There are a lot of people out there that made money starting during COVID till now because the market was red hot. Right now, though, we're seeing the market all in turmoil. It's complete chaos out there. So you want to ask, were you around during the last downturn? And did you do well, not just buying properties, but did you sell some properties during that downturn as well? Were you able to keep investors happy? Did you communicate with investors? One of the best ways to tell if the syndicator is a good syndicator or not is ask them for their past communications and what their communication cadence is. Are they communicating with their investors once per month, once per week, once per quarter, once per year? Look at them when you're asking this question. I would do a Zoom call with them to see, because if they squirm around a little bit and they're not dialed in on their cadence, we put out a video every month, the first week of the month. And we do that on all of our properties so that everybody knows what's going on. We give a spreadsheet, we send an email, but we also send a video that's usually 3 to 5 minutes just going over what's going on with the property. We like to communicate with our investors so you sleep well at night. They should be able to show you examples of that. If they say they can't, you need to ask some hard questions. Okay, so that's number 3. Find an experienced syndicator to put your money with. Number 4, you want to make sure that you're investing in the right asset class for maximum returns. So there's A-class properties all the way to D-class properties. What you want to do is you want to make sure you're investing in an asset class that maximizes the NOI, that is net operating income. This is how you make your money in real estate in apartment buildings. So NOI is the net operating income. All the rents come in minus expenses, what's left. This is how banks appraise apartment buildings, and this is the power that apartment buildings have over single family or duplexes, triplexes, 4 units. So how do you get the NOI up the fastest? That's what doubles the value of your property. That's what puts more money in your pocket. Well, A class, they're not going to be raising rents very rapidly, right? These are the fancy, brand new builds, luxury. They're already charging a premium. It's going to be very hard to keep raising rents there. You're not going to see that happen. B-class properties are A-class properties that are now 5 to 7 years old. You're also not going to see it there. C-class properties are your workforce housing. It's where 80% of the population that rents lives. That's where you want to be, because rents tend to go up, especially during a recession or when times get a little bit tight. These are the properties that have wait lists. That means that rents are going to steadily climb and you're going to be able to maximize your returns. So the right asset class, you don't want to be in A, you don't want to be in B, you want to be in C class properties. D are your war zone properties. There can be a lot of money to be made there, but it can also be really, really rough, and you're probably not going to sleep all that well at night. I would stay with solid C-class properties. We call them boring brick buildings. We always try to buy brick buildings because they need the lowest amount of maintenance, and they do really, really well. But regardless, C-class housing. All right, we are coming up to number 5, and I'm going to give you guys a secret here at the end. It's where a lot of syndicators pull the rug out from under investors, and you don't even know about it. So number 5 is, what kind of returns are you looking for? When people are talking to you, there can be a lot of complicated language out there, so I want to simplify it for you. You are looking for a 16% IRR or better. IRR stands for internal rate of return. It's the rate of return that your money is expected to get. Now, it's real estate, so there is no guarantees, but they should have a target in mind. You want to see a 16% or better target. The second thing that you want to see is a 1.8x multiple. A 1.8x multiple means you're going to put in $100,000 and you should get $180,000 back. That is what a 1.8x multiple means. Now, again, real estate, no guarantees. That's what you're aiming for. It usually has to do with the number of years that they are holding it. If you're getting an 18% return and you're looking for a 1.8x multiple, it's probably going to be a 4 to 6 year hold, depending on how fast they can raise the NOI, which we talked about in the last point. Now, here's the secret. Where do sneaky syndicators change things around on you? And it is called a flexible waterfall. So what is this flexible waterfall? So a normal return is stated as a 30-70 or a 60-40. So a 70-30 would mean that 70% goes to the investors, 30% goes to the management. 60-40, same thing. 60% to investors, 40% to management. Where some syndicators get really tricky is they have this big flexible waterfall. Year 3, year 4, the waterfall starts to move around. And they say, well, it's because the property is making more money. We're still going to keep you at your solid rate of return, blah, blah, blah. Here's the thing. They're keeping all the profit. Year 3 is when the property really starts to turn because rents have gone up, the NOI is getting better, there's more cash flow. The syndicator is just stuffing their own pockets with that instead of passing it along to investors. What you want to look for is a fixed waterfall. Where they get really crazy is by creating this flexible waterfall, and it can be complicated and it looks crazy and it's hard to understand. Most people are just going to say, well, I trust you, so I'm going to give you my money. If you hear the word flexible waterfall, run away. All right, I hope you enjoyed this video. If you would like the 5 landmines of passive real estate investing, it is available down below for you. We'll see you in the next one.